All right, let's talk about the holy grail for investors, finding those multi-baggers. You know, the stocks that can completely transform a portfolio with massive long-term growth. This isn't about getting lucky. It's about having a system, a framework you can use again and again. So let's dive in.
I mean, who hasn't dreamed of this, right? Finding that one stock, that one company that just delivers life-changing returns. It can feel a lot like trying to find a needle in a haystack. But what if I told you there's a logical process, a kind of map you can follow to seriously boost your chances? It's really not about luck, it's about the framework.
So how does a stock actually become a multibagger? Where does all that incredible growth really come from? Well, it all boils down to some pretty simple but really powerful math, the idea of market cap expansion. Let's break down how a good company can turn into an absolute giant.
Okay, first things first, we need a baseline, a starting point. As of today, regulators in India consider a large cap company to be one with a market value of at least 1 lakh crore rupees. Just keep that number in your head, because that's our goalpost. We're on the hunt for smaller companies that have the potential to grow to that size and hopefully way beyond it.
Now, why is that 1 lakh crore number so important? Because the goalposts are always moving. Think about it. A company that's considered a giant today is way bigger than a giant from 20 years ago. If that trend continues, a company hitting that 1 lakh crore mark today could easily be worth something like 16 lakh crore in the future. That is a 16x return right there, just by keeping up with the market's growth.
And if you want a real-world example, this is absolutely perfect. Take a look at Reliance. Way back in 2004, it was the #1 company in India, with a market cap just under 1 lakh crore. Think about that for a second. The biggest company back then wouldn't even crack the top 50 today. And yet, from that top spot, it still grew more than 20 times. That is the incredible power of market expansion we're trying to find.
Okay, so the math makes sense, the potential is clearly huge, but where in the world do you start looking for these future giants? The whole market is a massive place. The secret is to narrow your search and focus on the most fertile hunting grounds.
And this is a really crucial point. History shows us that these huge winners don't just pop up randomly all over the place. Nope, they tend to be packed together in just a handful of specific sectors. If you know where to look, you can ignore a ton of noise and distraction.
So what are these magic sectors? Well, the data shows a few clear winners over time. You've got IT services, because they can scale up globally. You have finance, especially the companies that are kind of like the plumbing of the market. Think exchanges and depositories. As the whole economy grows, they grow. Then there's pharmaceuticals, which can be a bit of a roller coaster, but the returns can be huge. And of course, consumption and FMCG, because as a country like India gets richer, people simply buy more stuff.
Okay, now for the super practical part. This is where the rubber meets the road. We know why we're doing this, and we know where to look. The big question is, how? How do we sift through thousands of companies to find the few that actually fit our rules?
The answer is, you use a stock screener. This is your best friend in this process, seriously. It's a tool that lets you set your own rules, your filters, and apply them to the entire stock market in seconds. It's like having a giant magnet that pulls only the needles out of the haystack, turning an ocean of stocks into a small, manageable pond.
So let's build a filter right now, step by step. First up is size. This is just common sense, right? If you want to find the next giant, you have to find it while it's still relatively small. So our first rule is to only look at companies with a market cap below 50,000 crore rupees. That leaves plenty of room to grow.
Step 2, we need a quality filter. Because it's not enough for a company to be small, it has to be a great business. A key metric here is something called return on capital employed, or ROCE. All that fancy term means is, how good is the company at turning money into more money? We want a business with an ROCE over 20%. That tells you it's a super efficient machine that can fund its own growth.
And finally, step 3, we add a safety net. Great businesses are built to last, and the last thing you want is a company drowning in debt. Too much debt can be a killer when times get tough, so we'll add one more rule, a debt-to-equity ratio of less than 1. This just makes sure we're looking at financially solid companies that can weather any storm.
So, after all that filtering, what kind of company actually pops out? Well, take a look at an example like CDSL. It pretty much ticks all our boxes. Its market cap is under our limit, its ROCE is a fantastic 42%, and it has basically zero debt. This is the exact kind of high-quality, financially sound company in a great sector that our screener helps us uncover.
Okay, so you have the math, You know which sectors to look in. You even have the tools to find specific companies. You think that's everything, right? But there is one last ingredient. And frankly, this is the hardest part of the entire process. It's the mental strength to just hold on.
This quote just nails it. Finding a great stock is maybe half the battle. The real challenge, and where the truly life-changing returns are made, is having the conviction to hold that stock through years of volatility, scary news, and market chatter.
Because, make no mistake, the long-term journey is an emotional roller coaster. In year 1, you're excited. By year 3, your stock could be down 50%. And trust me, even the best ones are, and you'll be filled with doubt. By year 7, you might be totally frustrated because it feels like everything else is soaring while your stock is doing nothing. But then, if you hang on, if the business is still solid, you look up in year 15 and you feel nothing but astonishment at what compounding has done.
So there you have it. The framework itself is logical. It's repeatable. It's based on math, proven sectors, and quality filters. But that entire framework is pretty much useless without the final, most important ingredient. We've covered the what and the how. Now, the only question left is the one on the screen. You have the framework. Do you have the patience?